Hey everybody, Elliot once again, Touchstone Financial Education, and today we are going to talk about debt instruments. But before we do, let's get a little business out of the way. Please check us out at touchstonefinancialeducation.com. We are now on X under Touchstone FinEd, and of course still on Facebook under Touchstone Financial Education. So let's get down to it. Debt instruments, and by that I mean bills, notes, and bonds when we are referring to government-issued debt. So a bill, or we affectionately call a T-bill, matures in 13, 26, and 56 weeks. A note matures from 1 year up to 10 years. So you've got the 1 year, the 2 year, the 5, and the 10. A bond will mature out to 30 years, so it's issued, that 15, 20, and 30 years. Some say bonds actually start on the 10-year mark. I like to think of a 10-year as a note. I'm old school, that's just the way it is. When we're talking about corporates, we are talking about bonds and notes. Again, a note 1 to 10 years, a bond pushed out to 30 years. And the reason why I have to explain it this way is because depending upon the maturity is going to determine the interest rate you earn, especially when we're looking at interest rate reductions. Most of us aren't going to go out and buy bonds individually. We're going to get them through our funds at work and a retirement plan. If you've got a retirement date fund, let's say you've got a 20/40 fund, you're sitting on 20-25% in debt. If you're an individual investor outside of work and you've got some bond funds, that's how you're going to go ahead and get these bonds. But here's the thing. The lowering of the interest rates is going to impact the yield or the income you will be earning. You say, okay, so what? Well, what does that mean? Well, for existing bonds that were issued at the higher interest rates these last few years, people are going to be scrambling to buy them because they're higher interest rates. And when a bond price goes up, the yield or the income comes down. So imagine a seesaw. Bond price goes up, yield comes down, or the amount of income you earn comes down. Conversely, when a bond price is high and the yield is low, guess what? They will switch it up. But right now, we are in an environment where that bond price will go up and that yield will come down. So what does that mean for you investors? What does that mean for you savers with high yield savings accounts and CDs? Expect lower rates. Now, I know there are a lot of institutions advertising right now that they're going to offer you 6+% on your high yield savings and possibly your CDs. Hey, that's great. But for the most part, those are going to be teaser rates because the bond market, the notes, the bills, the bonds, they will be changing as a result of these lower interest rates. So be mindful, and here's how you can watch. Go to bankrate.com and you will see over the next several months the rates offered on these cash savings accounts, high yield and CDs, are going to be coming down. Okay, so just be mindful. It's not bad. It just means you'll be earning a little bit less going forward than you did a few months ago. The rates are still going to be good historically speaking. So don't think you're going to leave your money in your checking account earning 0.0. No, not at all. Or a traditional savings account at about 1%. We want still that higher rate, whatever it's going to be. If you're interested in buying government issued debt, please go to treasurydirect.gov and you can buy them directly, but you could also buy them through your retirement plan provider. You could buy them through places like Vanguard, Fidelity, Schwab, TD Ameritrade. Wherever it is you have your investments, you could pick up this government debt. But for the most part, know that money managers are out there working hard for you for that bond component of your portfolio. Be mindful of the rate changes on those high yield accounts and CDs. And that's it, guys. Thanks for watching. If you have any more questions on this, please reach out. We will get back to you. This is Elliot once again, Touchstone Financial Education. Thanks for watching and listening.